Limited to Alliance SA. He has spearheaded the CAL team through Sri Lanka's post-conflict economic landscape towards market leadership in equity capital and debt capital market, mergers and acquisition, as well as equity research. CAL's stockbroker in arm is also one of the largest brokers of foreign funds into Sri Lanka. Mr. Pushparaj is a CFA charter holder and a fellow member of the Chartered Institute of Management Accountants, as well as the Association of Chartered Certified Accountants. Thank you, Deshan, for accepting our invitation.
Thanks for having me, Aruna. Glad to be here.
So I think now we can start off with the presentations. Let me introduce the first team to you. The team from University of Colombo comprises Uttara, Sugandharaj, Vindhya, Dilhari, and Charuka. Over to you guys.
Team, are you ready?
Just give us a second. One person is in the process of joining.
Sure, that's fine.
Charuka, we are ready to go.
All right. So you all have got 10 minutes to make your presentation. You all may start now.
A very good evening, ladies and gentlemen. We are here to present investment thesis of Overseas Realty. Overseas Realty is a top-ranking property development and investment holding company that has a philosophy of developing quality properties to achieve maximum long-term investment value. We issue a buy recommendation with a target price of 18 rupees 7 cents, which is a 25% upside from last closing as at 21st December 2020. Our recommendation is driven by, firstly, resilience performance despite the impact of COVID-19. The absence of premature lease termination and WTC support the argument. Secondly, the stable revenue streams are expected to exceed 9 billion rupees with the completion of Miracle Hours. Lastly, companies to capitalize on solid long-term market opportunities. On one side, high demand is expected for Grade A and commercial space, while on the other, occupancy level is around 90% for commercial buildings. Company mainly have three segments: property leasing, property trading, and property services. WTC is the first real estate development project in Sri Lanka, which provides 750,000 plus square feet commercial and retail space. Facility Management Services is the largest integrated facilities management services provider in Sri Lanka. 66% of units have been sold in Havelock City Phase 3 and 22% pre-sold in Phase 4. As a result, revenue of property trading has increased to 4.2 billion and 6.1 billion in 2018 and 19 respectively. Nevertheless, it shows a cycle where core revenue is mainly derived from property leasing for the rest of the year, starting from 2015 to 2024. To continue with investment thesis, over to you, Uttara.
Real estate industry is an emerging growth point in Sri Lanka. However, uncertainties arise from COVID-19 added pressure on tenant side decisions. Overall vacancy rate of Grade A office building increased to 18.7% at the end of the third quarter of 2020. In contrast, OSCA was able to generate stable revenue streams and marginally increased vacancy rate only by 5%. With the completion of the Havelock City Commercial Development Project, Mireka Towers will generate revenue streams above 9 billion from 2022 onwards, hosting 112% revenue growth. The contribution of the Mireka Towers to the group revenue will reach 38% at the end of the forecasting period. In the long run, industry dynamics and the demographics in the country undoubtedly favor OSCA. The urbanization level in the country stood at 80% in 2019. As a result of that, Sri Lankan citizens are opting for land and houses in metropolitan cities and suburbs, which are hardly affordable. In such circumstances, vertical living is a highly viable option. But in Colombo, vertical living stands at only 10%. It gives a green signal that Sri Lanka's vertical living has more room to go in the future. Moreover, there can be observed a clear supply shortage of Grade A office buildings in the country. It will favor OSCA to secure the current industry position while opening the doors for future developments. There are supply shortage in Grade A shopping malls as well. Further, we expect that healthy occupancies of Havelock City shopping mall will complement the low mall penetration level in Sri Lanka. This will definitely boost the bottom line of OSCA in the short run. In the long run, it will offer opportunities for business expansions. Let's move on to the financial analysis to our thesis. During financial year 2015 to 2019, group revenue growth recorded a positive growth, except for the year 2016 due to the lower revenue recognized from apartment sales. During the forecasted period of 5 years, from 2020 to 2024, group revenue will show a positive growth except for the financial year 2020. We expect that revenue recognition from apartment sales will be decreased due to the COVID-19 outbreak during the year. However, we assume that COVID-19 impact will be neutralized and the group revenue will be increased by a five-year CAGR of 40.87% at the end of the forecasting period. Continuity with EPS and free cash for the firm. Over to you, Sugandhi.
Historical EPS performance shows a volatile performance during the period of 2015 to 2019. We expect the EPS to grow at a CAGR of 29.5% during the forecasted period 2020 to 2024. OCA's free cash flow performance shows a growth perspective during the period of 2015 to 2024. Except for the years 2019 and 2020. In 2019, OCA has incurred a high level of capital expenditure relating to the ongoing commercial project Mireka Tower. In 2020, OCA experienced a lower revenue from apartment trading, and as a result they have experienced higher marketing and administration expenditure from the launch of Phase 4. Moving on to the valuation, we have valued OCA using discounted free cash flow method as a primary valuation, and we arrive at a target price of rupees 15.40, an upside from the closing price as at 21st December 2020 for 14 rupees 40 cents. For the DCF valuation, we use the WACC of 12.75% and terminal growth of 2.5%, considering the COVID effects and the growth opportunity in the industry. 5-year Treasury bond average is taken as the risk-free rate. OCA's beta is calculated by using 5-year ASPA return and OCA return. We estimated the market risk premium as 7.3%. Moving on to the relative valuation, price to book value and PE multiples are trading at the discount of 25.8% and 48.25% discount, which indicates the OCA stocks are currently trading at a discount. Clear analysis indicates that OCA's revenue growth is 5 times higher than the industry average, and ROE is well above the industry average. To derive the OCA's value by considering the fair value appreciation, we provide 75% weight to discounted free cash flow method and 12.5% valuation value to price to book value multiple and PE multiples, and we finally arrive at a price of 18.7 cents, 25% upside from the closing price. Sensitivity analysis is done by changing key variables by 1%. The most sensitive variable is cost of equity. It stood at an 8% downside when the key variables are changed by 8%. Even with the 8% downside, the price stood at a level of LK rupees 14 rupees and 21 cents. Therefore, we strongly recommend our buy decision. To continue with risk analysis, Dilhari, over to you.
Yes. Now let's have a look at the investment risks of overseas reality. When looking at the major risk factors, health and safety concerns stand at the highly impacting and highly occurring quadrant of our risk analysis. Due to the prevailing COVID-19 pandemic, there could be some holes of the overseas reality constructions, and therefore we expect that their future earnings might get delayed. However, we expect that this risk might be mitigated because of the start of the vaccination program in Sri Lanka. And the high construction material costs also impact highly, and it will be occurring highly, and it will be also a high risk to overseas reality. When looking at the moderately impacting factors, rising industry competitiveness and the exchange rate fluctuations would be moderately impacting. Now I'm moving into the conclusion of our investment thesis. Resilience business performance of overseas reality despite the impact of COVID-19, their new commercial project and capitalizing on solid long-term opportunities drove us towards giving them a buy recommendation with 25% upside and arriving at a target price of 18 rupees and 7 cents. With that, I would like to conclude our presentation, and now the floor is open for questions. Thank you.
Judges, the Q&A session starts now. The time allocated is 10 minutes.
Maybe I can ask the first question. First of all, good job. And now comes the fun part. My first question is, it looks like EPS is almost doubling by the time you get to your final EPS period. One of the mistakes that analysts often make is they put too much value into that final year, and therefore their free cash flow, which we can see in this chart, is also quite high. You can see your free cash flow in the final year goes from, I believe, 6 to 8 million. So I would just like you to talk about that final year and your comfort in the final, let's say, 2 years, because if something was to go wrong, that could hurt your estimate of the value.
Yeah. Actually, the revenue is recognized from the apartment sales based on the revenue recognition method. This will increase the revenue recognition in the later years. During the 2020 and 21, we don't have high level of revenue recognition from apartment sales, which contributes to the increase.
So my question, I guess, is just that in that final year, your free cash flow is 7,637, and it's a big number. It's a big jump from the prior year. Is there any risk to that number, or are you saying that it's secure?
Well, I will answer for the question. From 2022, there is a new development project coming in. It's Havelock City Towers. It compromises with a shopping mall containing 200,000 square feet, with the office space coming in with 600,000 square feet. With that, as we mentioned in the investment thesis, there's a solid market opportunity to grow. And after 2022, that's why there's a high growth potential we can see in the free cash flow as well as for the EPS.
Okay, I'll turn it over to other judges.
Maybe I can go next. Again, good job, everyone. Just wanted to understand, there are two main business lines here. One where you're building to sell, and another where you're building to lease. These are very different businesses with different risk return How have you captured these two different risk return profiles in your valuation and also in your thesis?
We have considered the DCF valuation as the main model for the primary valuation model, which captures the cash flows from the rental income and trading income. To capture the fair value gains and price appreciation, which comes from the rental sector, we have considered the price to book value and PE multiples. Trading income mostly contributes to the cash flow, and it will be covered under DCF valuation.
On an ongoing basis, do you expect that both business models will continue and thrive, or have you looked at once this immediate project is over, that the business will become a rental income model?
Yeah. Once the builded apartments are sold off, there will be no upcoming apartment projects. Therefore, apartment trading income will come to a lower level, and it will change to rental income.
Yeah, I'll ask the next one. I mean, just primarily because on your valuation relies a lot on your back assumptions that have been given there. How comfortable are you with using a risk-free rate of about, I think you had about 8% on your assumptions? And what's your logic behind that? What's driving that view?
We have focused on the period of 5 years. Therefore, we consider 5-year treasury bond average rates. Since current treasury bond rates are at a very low levels, we consider this one to be continuing for a long time. Again, the treasury bond rates will come to previous position. Therefore, we took the average figure and used it for. Therefore, this will support the risk-free rate in the long term.
And just one follow-on questions on some of the stuff that you have said. I mean, you seem to be fairly confident in the company getting back to occupancy levels that it had pre-COVID. What really drives your view there?
Okay, basically the organization or the OSCA involves in 3 business segments as leasing, trading, and the services. Leasing segment contributes the most of the business. It is around 60%. And the tenants, when it comes to the tenants of the WTC, they are very solid and the high performing organizations and providing the core services to the country. Like there are government institutions, a lot of government institutions are there, and the impact or the likelihood that they are moving out from the WTC is really low, because they are core business, they are offering the core services to the country, and they have to continue their agreements with WCC.
And the government, like government organizations like CSC, Security Exchange, and BOI is also under that. So it's like there's less probability that they will go out from that.
Just a follow-up question that one, there is an immediate impact, and then also a kind of a long-term trend, especially with COVID and people working from home and maybe buying online, especially when it comes to retail. The bigger dynamic that's been unleashed because of COVID. How do you foresee that impacting the company's rental income in the future?
In the terms of retail space?
Retail and office with work from home, and retail from more people kind of being more willing to buy online as opposed to in a physical location.
Yeah, I will agree that there's a trend from work from home, but it is not the case with OSCA. As I mentioned earlier, that the nature of the tenancy is a bit different, and there are high-performing organizations such as Dialog, Asiata, SLT. Those kind of businesses cannot work from home. I think there will be an impact, but the impact will be really low. In terms of the retail spaces, I mean, yeah, this is a occurrence that the online shopping and all. But in terms of having the shopping mall is not just for the shopping, I think. The shopping experience there, people, citizens, as well as the tourists is looking for is a big deal. I think from that, there is a competitive advantage have for SEA because of their facilities and all.
Yeah, just to add for that, since this is a grade A shopping mall, rather than buying online, just after the COVID pandemic period, we expect that people would move again to this grade A shopping mall, and the occupancy levels would be high for them.
Can I also ask, you've got a 25% upside. What is it that you're seeing that the market's not seeing? Like, what have you found from your research that you'd like to highlight that you think the market's not seeing as clearly as you are seeing?
OCA has a good fundamentals which are helping it to build the value, which outsiders are not aware about. Like they have undertaking projects which are like going to be launched. Therefore, people are not aware about it. When they launch it, there is a good potential to capture the market, and they will become solid in their performance. Since OCA is already performing very well in the market, it's leading the market. There's a potential in the side of their performance, fundamentals, and brand recognition.
Can you go to page 15?
The time is almost up. Maybe you can ask one more question and we can conclude.
Can you go to page 15?
Just a quick one from me. I mean, you said that there are some tenants that who you're quite confident will continue to remain with them afterwards. I mean, do you know as a percentage of their revenue or floor space, what number that might be? How much do they account for?
Actually, we didn't look on that aspect, but most of the tenants are like that. There are very few retail tenants are in the WTC. Most of them are government securities and corporate institutions that are performing really well. As a percentage wise, we didn't look on that aspect.
Okay, thanks.
All right, I think we can conclude. Over to you, Samaka.
Thank you, team. Thanks, judges. Please let me know when you are ready to move on to the next presentation. Great.
Thank you for your time, Asim.
Well done.
Thank you very much.
Thank you very much.
Never in the history of the financial services industry has it been through such a change. Markets are evolving swiftly. Customer expectations are growing. Business models are being disrupted. And regulators are bringing in new reforms. Being a leader is not enough. Organizations need to evolve and transform. Human capital needs to be integrated with emerging technology. We bring 20 years of experience of being a trusted partner to financial services firms. We improve front office efficiency through our tailored research, analytics, and data services, empowering global financial services companies to innovate and transform their business models. Our proprietary technology and automation platform, Beat, provides domain-specific technology crafted to clients' needs. We are committed to driving clients' revenues, improving operational efficiency, and continually innovating to transform our clients' business models and processes, enabling them to do more with less. We are Acuity Knowledge Partners. Empower, innovate, transform.
So next up, we have the team from University of Sri Jayewardenepura, and we have Bindula, Hirsa, Ishanika, Varuna, Chamini, and Shabik presenting to us today. Let's just give them a couple of more minutes to join the call, please.
Hi team, have all your members joined? Are you ready to begin?
We are expecting one more team member, Travis. We'll get back to you.
Okay, sure.
Are we good to go, Bindula?
Yes, I'll be uploading the presentation now. Just give me a minute.
All right, team. You have got 10 minutes to make your presentation. You may start now.
Real estate is like a chess game. All it takes is one move to lose the game. Good evening, investors. We, Team A from the University of Sri Jayewardenepura, issue a sell recommendation on Overseas Realty Ceylon PLC based on a target price of ₹11.21, reflecting an 18.2% downside from the close price. Overseas Realty Ceylon PLC or OCR operates in three segments, namely property trading through the sale of Havelock City luxury apartments, property leasing through the renting out of Grade A office spaces in the WTC and the upcoming Havelock City commercial complex, and property services. Despite OCR's high historic revenue growth, we issue a sell recommendation based on these factors. 1, our lackluster outlook on the Grade A office space market. 2, the geographical mispositioning of OCR's upcoming projects. 3, the intense competition faced by property trading and the WTC. And 4, the depressed financials resulted by the above factors, leading to the reduction in the bottom line for OCR's investors.
Colombo's Grade A office space market is likely to go through some tough times ahead. Based on the slow U-shaped economic recovery forecasted by many economic pundits and the World Bank, we expect that the generation of well-established local businesses would also be slow, resulting in the dull demand for high-end office space market in the medium run. With the country's imminent debt crisis and with the poor showing in the Fragile States Index, the inflow of foreign MNCs would also be low in the medium run. The pandemic has dealt a massive blow to the industry. The shifting of tenants from Grade A office spaces to lower graded office spaces and the lack of desirable interest in new office spaces have created an unhealthy oversupply in Grade A office space market. In OCR's case, 48,000 square feet of WTC's office space have been lost since the start of the pandemic. Moreover, with work from home being popular among employees and employers, the industry is facing uncertainty like never before. We expect these factors to exert a downward pressure on the demand for Grade A office space market, leaving OCR vulnerable.
In real estate, all that matters is location, location, location. That being said, OCR's upcoming Grade A office space addition Miraka Tower is located 7 kilometers away from the central business district, failing to provide its tenants vital perks that are offered by its peers in the CBD. Further, the cancellation of the LRT project by the government also dampened OCR's hopes in bringing Miraka Tower closer to the CBD. It is likely that the market has captured this flaw in location of Miraka Tower since none of its office spaces are pre-leased so far. This is in stark contrast to Cinnamon Life office spaces, whereby already 40% of its office spaces are pre-leased despite the pandemic. We also believe that the high-end Havelock City shopping mall to be geographically mispositioned as well. Being located outside the Colombo shopping precinct, it would fail to capture both the lucrative tourists as well as the locals. Why not the tourists? This is because of the lack of 5-star hotels in the vicinity of the Havelock City shopping mall. We also expect the locals who are used to shopping in the CSB, which is a destination shopping hotspot, to continue to shop at the CSP. Therefore, the geographical mispositioning of these upcoming projects will reduce future occupancy rates, reduce pricing power, and impair the quality of new sustainable revenue generating sources.
When speaking of competition, Havelock City Luxury Apartment faces competition on many fronts. Our peer analysis shows that there are better alternatives in terms of price, location, and even amenities. For example, Marina Square, which is located at a prime location with matching amenities as Havelock City, sells their apartments at a 35% discount. Losing the first mover advantage of a city within a city concept and the competitive disadvantage of being a pure player has hurt OCR competitively. The reduced rental yields of the Colombo City apartments and the relative cheapness of suburban property has also made the apartment in suburbs more lucrative for the speculators. These factors, along with the eventual aging of inventory and the effects of pandemic, we forecast would lead to a drastic drop in the velocity of sales of Havelock City compared to its previous phases. When talking about WTC, its current pricing strategy would be unsustainable in competing with the new office space additions. This is supported by the revenue breakdown we performed considering the price and volume effects of WTC. Moreover, based on the decreasing occupancy rates over the time, we forecast that the WTC has been pushed from its maturity stage to decline stage.
So what does it all mean financially, and how does it concern you, the investor? The average occupancy rates for investment property will decrease to 71% by CY26 because of the geographical mispositioning of Havelock City commercial complex and poor outlook on the industry dynamics for Grade A office spaces. Further, property trading revenue will reduce at a 14.6 CAGR due to the deferment of purchasing decisions, change in consumer priorities, and stiff competition, dampening the demand for Havelock City apartments. These will drag down the total revenue at 2.2% CAGR over the forecast period. EBITDA margins for property leasing will reduce by 16 percentage points due to the poor pricing power and subdued demand for geographically flawed projects, as well as their inflexible cost structure, offering space for anchor tenants at a discount. And OCR's inexperience in dealing with retail spaces will also contribute to this EBITDA drop. A gradual rise in gearing is projected in our forecast period, as we believe OCR will need to borrow fund to fund the 27 billion rupees worth Havelock City commercial complex. The dull cash flow generation from the apartment sales in the medium term will force OCR to finance most of the remaining investments through borrowings. This will squeeze net profit margins as we expect the interest burden to hit the income statement after the completion of the project. With high interest burden driving down the net profit margin to 29.1% and underutilization of rentable space pulling down the asset turnover to 0.12 times, OCR's ROE will reduce by 430 basis points during our forecast period.
Moving on to valuation, our sell recommendation is based on a target price of ₹11.21, representing an 18.2% downside from the price as of our valuation date, with 70% of the value coming from DCF and 30% from relative valuation. We employed the free cash flow to equity approach and used some of the parts where we valued each segment separately and calculated the price based on 3 scenarios, arriving at an expected DCF price of ₹9.87. We used different costs of equity for each segment based on CAPM, and our risk-free rate of 6.6% is based on the 5-year Sri Lanka Treasury bond rate, while our terminal growth rate of 3% is based on Sri Lanka's long-term expected GDP growth rate. We used the PE ratio for our segment-wise relative valuation, which derived a value of ₹14.34, accounting for 30% of our target price. The NOI approach was used to derive the net asset value of ₹8.58, which also supports our sell recommendation, and the gap between the widening gap between the market price and the book value shows that this will continue in the future as well. Moving on. Our sensitivity analysis assesses the impact of cost of equity and terminal growth rate fluctuations on our target price, and the average occupancy rate was the most sensitive variable based on our analysis. We would like to highlight two specific risks to our recommendation. The prolongation of the low interest rate climate would extend the window of opportunity for speculators and end users to purchase Havelock City apartments. Further, the removal of value-added tax on condominium sales and the continuation of other favorable implications of the recent budget is also a key risk to our recommendation.
Now, let us focus on OCR's ESG efforts. OCR has carried out commendable initiatives when it comes to environment and sustainability, specifically focusing on energy conservation, water management, and uplifting biodiversity. OCR has also taken steps to ensure the safety of visitors, tenants, residents, and employees of Havelock City and WTC. However, they have not carried out any CSR activity targeting the wider community throughout past 7 years. This approach to CSR would be an improper fit to the modern business world. We would like to question you, the investor, about the OCR's governance and shareholding structure. OCR's board mostly consists of non-independent directors and they lack a formal nominations committee. Further, OCR has failed to meet the minimum public shareholding requirement as per the CSC listing rules and faced the possibility of potential listing downgrade. 85% of OCR's shares are being held by top 5 shareholders. What does this mean for you as investors? The risk of your shareholder rights being trumped by the majority stake shareholders is really high. This was in full display when the board approved dividends was cancelled by the majority stake shareholders.
In conclusion, real estate is like a chess game. All it takes is one blunder to lose the game. But unfortunately for OCR, we have found 4: a lackluster industry, geographical mispositioning, intense competition, and depressed financials. So what's your next move? Thank you. The floor is open for questions.
Maybe I'll start off. Excellent presentation. My question is, when you say a sell recommendation with the downside, what's happening with the share price? Is this already reflected? And how soon do you think the share price would fall? In other words, if I do not own this stock, would it be the type of stock that you would say you should try to short it now? Or is this just that if I own this stock, I should start to unload?
Yes. So currently the market price is hovering around 15 rupees, which is above the closing price as at our valuation date. But we believe that when the fundamentals are reflected in the earnings reports, the market would react, especially as the latest earning report actually, which was released a few days ago, had an impact on the share price as well. There was a 10% drop yesterday, so, not a 10%, minor drop. So if you're an investor, I would, so how I would pitch this sell recommendation, despite the fact that it is above our closing prices, just look at the catalyst that we have mentioned and just think for yourself and make an informed decision. And we are here to inform you. Okay.
Can I ask you about the EBITDA, just because we have a short amount of time? So can you go to the EBITDA chart just for a second, or the EBIT margin that you were showing earlier?
Sure.
Yeah, this chart right here. The dotted red line on the right chart shows 2022. That's when the big drop happens in the margin.
Yes.
So that's a little drop is happening right now, according to this chart. But it's based upon, your recommendation really is based upon that big drop happening in 2022. What's the risk that you could be wrong in that big drop happening? I mean, it's run by a management team that does want to prevent that, right?
Yes. So we we forecast that the upcoming Havelock City commercial complex, which is the Grade A office space, that is the Miraka Tower, and the high-end Havelock City shopping mall to be geographically mispositioned. That was our second catalyst. So we believe that once it is opened, actually currently based on our valuation date, the occupancy pre-lease rate for Miraka Tower was 0%. But we've been prudent enough to give them a start of 40% when they start in CY 2022. So based on that flaw in location, that is why we have highlighted, okay, pre-WTC, okay, EBITDA has been at a higher stage, but post-WTC, that means WTC and the Havelock City commercial complex, okay, that is the time when they will really suffer. That is our pitch.
Let's turn it over to the other judges.
Okay.
So quick question from me. Industry dynamics aside, interest rates are at an all-time low right now in Sri Lanka, which should then also help, anything to do with rental yields and the value of rental yields in a low interest rate environment. You've used very high discount rates. Can you explain why you've used such high risk premiums, especially on an industry which can give you stable cash flows?
Yes, to answer your question, we have used an equity risk premium of 11.9%. So if we look at how we have calculated this, we have used an indirect method where we initially calculated the country risk premium, and then we have used the US S&P 500 index as our base index, and then by adjusting it for the market return of US and the risk-free rate of Sri Lanka, we have come up with the equity risk premium of 11.9%, and we consider this rate to be justified by the risk factors faced by the country, and also the downgrading given by many organizations such as Moody's, Standard & Poor's, and Fitch Ratings in the recent past.
Hi, my question comes down to, I think, just follows on a little bit on what Andrew was asking as well. It seems like most of the risk you see is coming from the Havelock City project and probably apart from WTC as well. On the Havelock City side of things, I mean, don't you feel that they might be following a somewhat different strategy there compared to what they're trying to do with WTC?
Yes, to answer that question, many Grade A office spaces, especially when if we take Miraka Tower, many Grade A office spaces are located in the central business district because of the inherent perks that are associated with that region. For example, there is a centralized transportation hub, then there are government offices, banks, and so on and so forth. So we really do find it concerning for OCR to have positioned Miraka Tower, its newest Grade A office space addition, at a location that is out of those, I mean, that is out of reach when taking those services. 7 kilometers away from Colombo 1, we consider Colombo 1 as a CBD. So that is reflected in the pre-lease rate that they witness, that is pre-lease of 0%. So meaning the market has captured that, and tenants are making a slight delayed decision to whether or not invest, or rather open their office spaces there. With regards to the Havelock City shopping mall, the most critical thing that we witnessed is that there are no 5-star hotels in the vicinity of the Havelock City shopping mall. And we all know once the COVID restrictions cease and once the public health regulations relax, most of the volume will be driven by tourists rich tourists.
So question?
Yeah.
One question I have is, I understand your point, but sometimes when you look at property, you look at it on a project basis. It could be, well, the land was cheaper, the building of the construction was cheaper, its operations are cheaper, or something like that. So, you know, they're not fools that are running the company. Could it be that you're looking at it from one side, but actually on the cost side, it's going to be okay from a project perspective? But just curious your thoughts on that.
Yeah, cost perspective. Offering grade A office spaces requires a certain level of service. So with regards to its low demand, meaning low occupancies, they'll have to still provide that service. So the cost structure would be actually unfavorable on them because they are promising a grade A level service, but they have to, their cost, meaning their cost will be high, but it won't be funded through the revenues.
That's happening to pretty much all property developers and property companies because they're struggling with the same issue.
Yes.
But what I'm asking about is maybe the project costs was much lower than if it was, you know, in the, you know, near WTC or down in the central district. And you're missing the fact that the overall project, forgetting about COVID, everybody's hit by COVID right now, but the overall project is not that bad. I'm just curious about that. I'm not saying it is. I just want to hear your response.
Yes. Yes, obviously there are two schools of thoughts. Of course, OCR went ahead with building its commercial complex near to the Havelock City apartments. That is because they wanted to deliver on the promise of creating that city within a city. So, but in doing so, they are risking that chance of having a low occupancy level because of their non-strategic location in compared to its peers. So we have considered several peers as well for the office spaces. So if you can see here, Miraka Tower is clearly located so far away from the other grade A office space providers. And this is the peer analysis that we did. So as you can see, because of this geographic mispositioning, their pricing power has also reduced. It's 290. That's what we forecasted to charge by 2022. And if you can look at Cinnamon Life here, this is the major threat that Miraka Tower has. So they offer rental, they offer an average price per square foot less than WTC themselves. So indirectly, WTC is also affected by intense competition faced by these property or other office space providers.
On that note, point is further,
I think we might have to conclude the question and answer session. Would you want to just make a closing statement? I think you are going to continue with your response. Maybe just conclude that and let's move on to the next item.
Yes, what I was going to say was that Miraka Tower, as Vindula clearly mentioned, they have only pre-leased 0%. They have not pre-leased any yet. But when it comes to Cinnamon Life, the main peer for Miraka Tower, they have already pre-leased 40%. So this is because of the catalyst that we have already mentioned, which is the geographical mispositioning. That's what we expect.
All right, Samaka, over to you. Let's move on to the next item on our agenda.
Thanks, Divankar. Thank you, team. You can stay on for the rest of the event, but please mute yourselves.
For me, the CFA Charter represents rigorous training and highly ethical behaviour. My name is Maria Abinizio and I'm based in Hong Kong. What's great about CFA Institute is it's a genuinely global organisation. Being part of CFA Institute allows you to quickly connect to other charter holders. It is actually, very diverse, and particularly within Asia, and that's very valuable when you're looking to make a decision, or when you're trying to think more creatively about a problem, I think, the more perspectives that you have, the more likely it is that something's going to spark. When I'm interviewing candidates, it does make a difference if someone does have the CFA designation. The program is somewhat unique because it spends a lot of time, or there's quite a large component of the curriculum focused on ethical conduct and very, very core commitment that you literally make every year when you renew your membership. What CFA Institute also does is really put a focus on really delivering for investors. The more individuals in the organisation that have the CFA charter and have that broad-based training, actually the higher the degree of competence you have to be able to genuinely engage with clients in a way that's about solving their needs. And, always coming back to first principles, always looking at the interest of the investors and putting that first. And that, I think, that's something that's very, very important for the industry.
So the third team for the evening is from University of Peradeniya. And we have Fatima, Purni, Yashani, Revati, and Prinda presenting to you today. Team, can you please confirm that you have all members on the call?
Hello?
Yes, you can be heard.
Yes.
Hello. Hello. Hi, Purni. We can hear you. Are you ready to start?
Yeah. Is it okay if I share my screen now?
Yes, please.
Yes, you can go ahead. All right, team, you have 10 minutes to make a presentation. You may start now. Team, when you're ready, you may start.
Sorry, sir, I was having a connection issue, so I could not join. Sorry.
That's all right, Fatima. Are you ready to start now?
Yeah, I'm ready. Thank you.
You may go
Let
ahead.
me start. Thank you. Good evening. We are Team D from University of Peradeniya, and we'll be doing our presentation on the investment thesis of Overseas Realty Salon PLC, hereafter referred to as OCE. We establish a strong buy recommendation for OCE with 100% upside on their stock. We'll be exploring as to why their stocks are underrated by the market. OCE is a premier grade A real estate supplier in Sri Lanka that has diversified into property leasing and trading segments at large scales recently. Their key properties are the World Trade Center and the Havelock City premises. Within 2021, planned Mireka Tower and the shopping mall at Havelock City will add to this. OCE currently has a total market capitalization of 18 billion with a free float of 13% at 1.24 billion shares outstanding. These shares are traded at 14.4 rupees as at our research date. So why should you consider OCE as an investor? We see 5 major reasons that market has overlooked. We believe the property leasing and the diversification and expansion in the property leasing and trading segments will strongly impact. Other major considerations are their low risk, high payout, and strong growth perspectives based on our financial analysis. Now let us elaborate these for you.
The leasing segment contributes with expanded revenue generating capacity and higher rental yield. Currently, the leasing revenue of over 2.4 billion is generated by the existing 576,000 square feet of the World Trade Center premises. A major advantage to OC is its locational value and owning the World Trade Center premises. We expect a capacity increase over 140% from the fourth quarter of 2021, adding a total 800,000 square feet to the market. We see this to be a diversification of their revenue streams. Occupation at World Trade Center is expected to be remaining at 85%, but from 2023 onwards, a slight decline is expected with market recovering post-COVID and Grade A office supply increasing simultaneously. Concerning about the Miraca Tower and Havelock City Mall, construction is ongoing, and with that, we expect the planned opening will continue in 2021. Again, with expected market recovery, we believe that demand for Grade A spaces will improve. Looking at the regional peers, OC yields the highest rental yield of 9%. Past trends reveal that their rental yield varies between 8% to 9%. We believe this is from the locational value of a World Trade Center with its current higher property value.
Completion of Havelock City Residential Phase 4 will add the remaining approximate 350 units with sales of around 20 billion. Apartments are sold with 30% to 40% margins currently, but we believe margins will go up with apartment price increases over our projected period up to 2029. We believe the segment will come to a close by 2029, with which it will stop generating revenue. Looking at the rising percentage of local and regional high net worth individuals, we expect a high demand for residential investments. Research proves that 29% of ultra high net worth individuals in the Asia Pacific region prefers to allocate 29% of their net worth to invest in foreign real estate. We believe this will drive OC demand considering their products are international grade. Additionally, Sri Lanka has relaxed the laws on owning foreign land, so we believe that foreign investors will invest more in our country.
As at 31st December 2020, their beta against the all-share price index stands at 0.88. And their market price stands at 14.4, while the value was derived as 28.8 blended. So this is a 100% upside. And if you are a risk-averse investor looking to invest in OC, would give you the most benefit considering this information. We believe OC has a strong capacity to derive more value to you as their shareholder.
With cancelled dividend in 2019, their payout dropped in 2020. Profits were reinvested in the commercial property development. This might sound negative to you, especially as a potential investor. Giving you the full picture here, we believe OC to be not paying the dividend for 2020 as well, given adversities with COVID-19, mostly cash flow issues. But our forecast yields an average payout of 51% in the coming years. With enhanced business capacity, we believe their payout ability will be heightened. We expect a revenue CAGR of 24% over 2021 to 2025. Havelock City Residential Phase 3 is forecasted to come to a close by 2025 and Phase 4 by 2029. We expect the revenue growth in 2021 is 41% year on year. OC is mostly financed via equity, which is 64% of their capital structure. The spike in 2021 is 1 billion borrow for the commercial development. Other than that, we expect the existing short-term debts to be the main debt components in other years.
Our valuation was mainly a sum of the parts valuation with supportive peer valuation. The leasing segment was valued using a free cash flow based DCF analysis. This was based on a WACC of 11.48% with a 7% risk-free rate and a 13% risk premium. A terminal growth rate was averaged at 2.2%. The trading segment was valued using a project-based net present valuation given the nature of the segment is temporary. We used net operating profit less adjusted tax for the segment to arrive at enterprise value using a discount factor of 13%. Services segment was valued using a net operating income based constant growth model. Net operating income for 6 years was averaged and was discounted using the WACC and the terminal growth rate. The discounted average was considered as the enterprise value. Addition of values of the three segments gave the total operating assets value of OC to which the vacant land in Havelock City was adjusted. Ultimately, the DCF-based valuation yielded a value of 28.97 per share. Under a pessimistic scenario, a share price of 25.64 and under an optimistic scenario, a value of 32.29 was derived.
The supportive peer-based valuation was carried out using price to book value and EV to EBITDA multiples. 8 peers were selected from the real estate sector, 6 locally and 2 internationally. The value of a share was derived as 28.6 rupees, considering the peer median multiples. Again, it's also hidden upside closer to 100%, considering their current share price.
In a scenario with a 10% discount to the peer median, a share price of 25.2 with an upside of 75% was reached. Again, in a scenario with a 10% premium to the peer median, a share price of 32.1 with an upside of 123% was reached as well. So considering all of these, OC's share price varies like this. Within a 52-week range, their lowest trading price was 11 rupees, while the highest being 16.2. The SOTP valuation method derived a value range between 25.64 to 32.3 per share, while the relative valuation derived a range between 25.2 to 32.1 per share. Looking at the historical trading patterns of OC, it reveals that they have traded at a premium of over 65% to their current price to book value multiple. And again, it revealed that they have traded at a premium of more than 172% to their current EV to EBITDA multiple. Therefore, we assume that currently OC is traded at a discount in the market. As we mentioned before, OC has strong growth potentials and ability to derive more value to you as their shareholder. Therefore, we do not agree to their stock being traded at a discount in the market like this.
2 minutes more.
We identified foreign exchange risk to be affecting OCA stock with a high impact. Looking at the fluctuating exchange rate, we expect USD exchange rate to be high, considering foreign currency contracts and borrowings. Construction contracts awarded to China Harbour Engineering Company with a 70% value considered on USD terms expands the risk as well. Rupees 6 billion in mixed USD LKR terms were borrowed at an interest of 5% and 10% for residential development. And a 1 billion rupee loan at 10% interest also exists, but with a grace period of 2 years. This led us to believe that OCA faces medium level of interest risk as well. Currently, their gearing stands at 16.45% with an interest cover of 27 times points otherwise. And they have the capacity to enhance their debt level as well. OCA faces enhanced construction costs, but their segmental diversification don't expect a large change in the cost structure. Among highly competitive industry players, OCA holds a strong position in the industry with the risk they face.
OCE's success is reflected through their strong corporate governance positioning. Their director board is backed up by 4 subcommittees, and they comply with the Code of Corporate Governance best practices as well. The only drawbacks were that their chairman was not an independent non-executive director, and 3 independent non-executive directors have passed their 9-year tenure period. Accordingly, we expect a dividend cancellation this year. So with this, the possible demand for OCE stock may lower with stock price taking a hit. But we recommend that for an investor, together with our analysis, the most appropriate time for investing in OCA stock would be with OCE expectedly cancelling their not announcing dividends for 2020 in sometime between March or February of 2021. So we are Team D giving our recommendation on OCE stock with a strong buy recommendation. Thank you.
Judges, you can start the Q&A session.
First of all, good job. There's a lot of information in this presentation, and I must admit that it was a little bit hard for me to figure out what is it that's driving this 100% upside. I think it's a multiple re-rating. If I look at your margins, if I look at your revenue, they look like they're reasonable increases. Is it just simply a multiple re-rating that you're expecting?
I'm sorry, can you repeat that? We couldn't hear the question.
Like you showed, is it just re-rating and doubling the multiple? Seeing that, or is there something? What is the driver of this 100% upside?
Okay. These are the main reasons that we consider why there's why the market has underrated OC stock. Actually, their leasing segment has. So if we look at their leasing segment, they're expanding with Miraka Tower and Havelock City Mall. So that has not been realized by the market as of now. And then there's their trading segment. So the trading segments phase 4 of Havelock City. Yeah, if we look at this, Havelock City contributes with the fourth phase revenue, and as you can see, the 2020 revenue has gone down, but from 2021 onwards, it's expected to be picked up again. We believe that in addition to those reasons, in addition to the reasons of their segmental diversification, they yield high dividend payout ratios over the years in our forecast. And we believe that the average payout ratio is 51% throughout 2021 to 2025, which is our forecast horizon. And accordingly, we believe that they will not pay dividends for this financial year as well, given the adversities with the COVID-19 effect and cash flow issues. Similarly to last year, where they cancelled dividends. And combining with that, the low risk, the low downside risk with World Trade Center premises, considering its tenant base is 80% consisting of rising ICT, BPO, KPO sector businesses, and its locational value, we have to consider that World Trade Center is right at the heart of the Colombo, the central business district. And again, we have to consider the fact that there have not been any premature lease terminations due to COVID-19 or anything. So it's a trusted business place. It is the business place in Colombo that everyone will look up to. So that's a that reduces their downside risk. And combined with that, they have really strong growth perspectives. If we go to this, they yield a higher revenue of 20%.
Other judges may have some questions, so let's see also. Thank you.
You know, if I can jump in with a quick one, I mean, 100% upside is not a small number to speak of. I mean, is there anything new that you guys are seeing aside from valuations that you think haven't been factored into the share price?
Mm-hmm. Okay.
Excuse me. If we talk about the trading sector, there are some significant hints that revenue from trading segment will increase in the future. Purni, can you go to slide number 40? 40.
Can you tell me the title, please?
Trading completion of phase 4 of Havelock City Residential. Actually, without the pandemic effect, actually construction at Havelock City Phase 4 is ongoing amidst the COVID-19 impact, and 95% of their staff resides at the site without halting the construction. So that will sufficiently provide the supply of the Phase 4, like grade A office space in the market, and also reduction of VAT from 15% to 16%, and tax exemption towards apartments below 25 million. Those are some other reasons that revenue from trading segment will go up in the future, in the near future.
So one question for me, from on the re-rating of valuation multiples. Why do you think at the moment the market is underrated OCs against some of its other peers? Number one, and number two, if you look at the overall industry, especially in Sri Lanka, the entire sector seems to be trading at a fraction of its book value. Any industry-wide factor that you see for that dynamic?
So yeah, compared with the peers, OC actually, if we look at this, the historical trading patterns of OC, they have actually traded at a 65% premium to their current price to book value and 172% premium to their EV to EBITDA multiples. And now they are trading at around a price to book value ratio of 0.38 times and EV to EBITDA multiple of 6.51 times. So we believe that because the market has underrated the stock without realizing the effects of their new properties, so they have a large potential, and that we have to consider that apartment sales have gone down and phase 4 has not been considered yet, and the leasing spaces have reduced as well with this COVID-19 effect. And then we have to consider the dividend cancellation effect and the high debt levels considering US dollar terms.
Answer about this EV to EBITDA chart for just a moment. We've got a historical average of 17.68. So it looks very cheap compared to the historical average. But what if you excluded that very large, bounce that happened up to 100 times EV to EBITDA in 2010? Would it really be as cheap as it appears? In other words, the long-term average is probably a lot less if we exclude this one exceptional item.
So Yashani.
Yeah. Can you hear me?
Yes. The main thing is just 17.68. If we exclude that exceptional period, maybe it comes out to 12 or something, or maybe 10. And I'm just thinking about, does it just appear that it's really cheap, but it's really not?
Sorry, actually the line is not clear. Can you repeat the last sentence?
Let me repeat, Andrew. I think the line is not very clear. I think what Andrew wants to ask is that there's a huge uptick in the EV to EBITDA chart in the and he thinks in the computation of historical average 17.68 times that has been included. And if it is taken out, how will the picture change? Is my phrasing of the question right, Andrew?
Yeah, we think enterprise value has not been reflected, does not reflect the properties of the leasing segment, Merakadawa and Havelock City Residential Mall. So the share price does not reflect the value of those properties, and the dividend cancellation that can be incorporated most of the investors seek profits, they want dividends. So when they are dividend seekers, when the company cancels the dividend, they think the company is not that valued. So but the enterprise value has been affected through that. However, we have identified high dividend payout ratios in the coming future. So we have incorporated that factor also there.
All right. I think our time is up in terms of the Q&A sessions. We can move forward from here. Samaka, maybe you can take over now.
Thank you, team. You can stay on the call, but please mute yourselves.
Hi, I'm Erica Estrada, and I'm a product manager with Kaplan Financial Education. I want to congratulate you on participating in this year's research challenge. As a participant, you'll stand out not only for your investment analysis, but also for showing grit and determination during this COVID-19 adversity. We're thrilled to have representatives of universities and Kaplan clients participating in this challenge. We're delighted to support those that share in our educational mission. We'd also like to give a special welcome to many of Kaplan's former and current clients who are participating as industry coaches and faculty advisors. Many of you may be wondering, why is Kaplan launching this initiative and with free resources? Well, you've chosen to invest in yourself, and we'd like to co-invest alongside you by making some of our resources available to you for this challenge. Prep resources from across our financial education offerings will help you stand out both in terms of this research challenge and your academic career. We wish you the best of luck with the challenge, and we hope that you'll find Kaplan's resources helpful for you. Welcome to Kaplan's free resources website for this research challenge. This is being launched for the first time amidst the pandemic to help take your research challenge to the next level. Our partners at the CFA Society will email the link to you. Please bookmark it as you prepare to tackle the valuation of your company as part of the research challenge. Your success in the research challenge depends on how well you understand a vast complexity of factors about one stock. To aid you in this task and arm you with the skills, Kaplan has curated 9 hours of programming across 21 videos from some of its best instructors who teach real-world exam prep courses. You'll also find benefit from the soft skills corporate management training videos that will equip you to succeed in the research challenge as well, and serve you well afterwards as you leave your university to move up the corporate ladder. You can also start lowering your costs of getting your first post-university finance credential by claiming your CFA Research Challenge discount of 15% off Kaplan's prep services by clicking on the portal link for the Chartered Financial Analyst, CFP designation, and FINRA securities licensing. You can access featured content from all 3 of these designations, which will be key to your research challenge's major themes. Do take advantage of the insights in our cash flow fundamentals video, which comes straight from Schweizer Prep for the CFA Level 1, which you, by the way, can take while still in your last year of university. How does your company fit into the world around it? You can put the ESG overlay on your valuation using our hot off the press video, which also contains insights on the COVID-19 impact on socially responsible investing from Kaplan's College for Financial Planning. Your team.
Okay, so now we have the last team. Another team from the University of Sri Jayewardenepura, and we have Ranmal, Tarushi, Taruka, Osuri, and Upeksha ready to present to us.
Whenever you're ready, you can start.
Hope you could see the screen.
Yes, we can.
You got 10 minutes. You may start now.
To thrive as an investor, towering high with reliance. Good evening, ladies and gentlemen. Overseas Realty Ceylon PLC, the proprietor of WTC, which is registered under WTCA for 23 years, Havelock City, serving luxury residencies and upcoming Miraca Tower. In the current turnaround of the economy, it is important to capitalize on persistent revenue generator advancing towards prevailing trends. The real estate sector in Sri Lanka is set towards recovery from its predicted oversupply, with Asia-Pacific market being a bright spot with only 5% decline in third quarter activity, especially with Chinese setting up its offices and broadening its financial sector. Moreover, Sri Lanka's strategic location is a hot topic further maneuvered with lower rental yield compared to Asian countries. The vitality of green spaces in urban environment.
My screen is shutting down when I'm screen sharing. Is there any problem?
Yeah, we didn't see a couple of slides, I think, or maybe a few seconds of the slide.
Shall we start again? Because my screen is let me share my screen again. I'm sorry. Hope you could see the screen again.
We can. Judges, do you want to decide where you want to start from?
I'm okay for them to start from the beginning.
Yeah, fine to start from start.
Great. Divanka?
Great. So time starts now. You've got 10 minutes.
To thrive as an investor, towering high with reliance. Good evening, ladies and gentlemen. Overseas Realty Ceylon PLC, the proprietor of WTC, which is registered under WTCA for 23 years, Havelock City, serving luxury residencies and upcoming Miraca Tower. In the current turnaround of the economy, it is important to capitalize on persistent revenue generator advancing towards prevailing trends. The real estate sector in Sri Lanka is set towards recovery from its predicted oversupply, with Asia-Pacific market being a bright spot with only 5% decline in third quarter activity, especially with Chinese setting up offices and broadening its financial sector. Moreover, Sri Lanka's strategic location is a hot topic further maneuvered with lower rental yield compared to Asian countries. The vitality of green spaces in urban environments has also sprung up, challenging the norms of high-end lifestyles. Aussie is a step ahead of the market, having already captured these opportunities. We, Team B of University of Sri Jayewardenepura, foreground on a buy recommendation for Aussie based on a 12-month target price of 17.28 rupees with 19.2% upside from the last close price following three main catalysts. First, Aussie re-establishing as the market leader. Second, expansion of target market. Third, strong financial health.
Proceeding with our first catalyst, OC is expected to re-establish itself as a market leader with sustained revenue aggregation. In the medium term, we expect OC to accelerate revenue by 33.9% by 2023, with Miraca Tower commencing with a 60% occupancy. Its shopping complex, targeted at the middle income earners, is a standout among peers due to the availability of commercial space in a highly residential area. It is forecasted to generate an accelerated 3-year leasing revenue CAGR of 23.8%. WTC is expected to reach rental rate recovery of 5% per annum latest by 2022, securing the best business address and having a relatively lower impact from work from home, given the high capex in shifting and strong B2B network. We estimate a 97% occupancy for WTC by 2027, being the most sought after commercial space provider, with Port City adding value in the longer term. Havelock City already possesses a green buffer of 38.9% with a 7-acre garden area. In times, urban greenery is a trendsetter, whereas the rooftop culture in competitors will not be effective in a tropical country like Sri Lanka. Only Tricent, which is a luxury peer, possesses a 1-acre garden area, but is priced 20.1% higher than OC with lesser amenities. Revenue is expected to be fully recognized between 2024 to 2026 in our scenario analysis, with well-established brand equity, returning expatriates, and lucrative post-pandemic lifestyle changes.
Moving on to our second catalyst, we expect that customers would redirect funds into real estate assets to capitalize the benefit of lower interest rates, with the pre-assumption that real estate assets will regularly appreciate. Moreover, increased urbanization and economic growth makes real estate sector very steady and low investment. Over the past 10 years, when AWPLR has fallen, it has increased the demand for apartments. And now AWPLR has fallen to 5.7%, and Aussie has signed an MOU with GFCC Bank when customers' financial recoveries are lengthened. With the influx of wealthy individuals, and per capita income has a major impact on increasing in demand and help to expand Aussie's current target market. The budget proposal has also mentioned that the non-residents and expatriates to purchase using foreign currency. The diaspora HNI survey has mentioned that 64% of NR diaspora are planning their purchases within the next 3 years in Colombo. We estimate that Aussie's 3-year trading revenue CAGR to be 56.8%, as 29% of Aussie's current tenant mix comprise of NR diaspora.
Further, elaborating our third catalyst, with Aussie securing its position as the market leader and increased customer base, we expect 3-year revenue CAGR of 37.2%. Aussie already owns land resources on new projects in Havelock City and in Southern Province, where commercial value is rising at the highest rate, hinting at future profit potentials. Further, when compared to the industry, Aussie has a buffer leverage capacity and revolving loan facilities, enabling flexible management of working capital. Working capital cycle will return to the lower levels as inventory turnover days will normalize after the third quarter in 2021. The current ratio for Aussie is estimated to improve to 2.8 times by 2027, with the reduction of the working capital loans of the company and regular cash inflows. The assurance of sufficient liquidity in current economic uncertainty make your investment trustworthy and secured. With all-around excellence, the ROE is expected to climb up to 8% by 2025 in our base case estimation. The NP margin of Aussie is expected to range within 60% to 62% and EPS to be 3.65 rupees by 2027 with a 3-year EPS CAGR of 29.4%. Thereby, we expect Aussie to successfully intensify the intended shareholder value with sustained growth and consistent profitability in foreseeable future.
Moving on to ESG, in the environmental pillar, Aussie's notable attention on energy efficiency, water conservation, and green building system has been rewarded with ISO 5001 Energy Efficiency Management as most energy efficient commercial building in Sri Lanka. As the stakeholder management system, the company has paid their special attention to the labor management and health safety of the stakeholders following government health regulations. The quality of the information provided by Aussie to stakeholders is verified by the M-score analysis we have conducted, scoring -4, indicating reliability and accuracy. The climax of the ESG, the governance attempt. Aussie could be considered as one of the best companies that implement a good governance system with sound experience BOD. Even though 85% of shareholding is owned by 5 main shareholders, all minority shareholder rights are treated with transparency and data protection through cybersecurity.
Moving forward, for our valuation, we use a sum of part DCF valuation after identifying the positive outlooks of Aussie and 3 economic recovery time frames. We arrived at 12-month target price upsides of 30.2%, 19.2%, and 10.1% at the best, base, and worst case respectively. We derived a WACC of 19.3% and terminal growth of 2.6% for leasing and services segment, while using a WACC of 17.7% for trading segment. In arriving at WACC, we use pure play method to find beta and 5-year Sri Lanka Treasury bond rate of 6.6% as the risk-free rate for our CAPE model. The terminal growth rate for leasing and services segment was assumed to be 2.6% in the base case scenario, considering the long-term growth of the leasing industry in Sri Lanka. We conducted a sensitivity analysis for terminal growth rate and WACC, which estimates an 81.2% probability for our buy recommendation. In addition, the net asset value per share of Aussie is estimated to be 35.9 rupees, affirming our buy recommendation, with Aussie's stock price undervalued by 59.6%. In multiple analysis, enterprise value to EBITDA and price to book yield target prices of 19.84 and 17.19 rupees.
Excuse me. Yeah, my screen sharing is a little bit trouble and the screen share is gone now. Can you just pause me? I'll try to back on that.
Divanka, can we pause the time? Can I request that someone else share the screens, please? Is there someone else from your team who can share the screen?
No, I hope you can see my screen.
Yeah, we can.
I'm sorry.
Yes, we can see the screen.
You may proceed. You have 1 minute more.
In multiple analysis, enterprise value to EBITDA and price to book yield target prices of 19.84 and 17.19 rupees with 36.8% and 18.5% upsides respectively, which support our buy recommendation. But again, always comes with a risk. We identified the property bubble due to the rise in interest rates, and delaying projects are the operational risk as the risk that would affect our buy recommendation.
On the final note, with OC establishing as the market leader with an expanded customer base inducing strong financial health, we, Team B of University of Sri Jayewardenepura, issue a buy recommendation for OC to you as an investor with a 19.2% upside to Tower Highway Reliance. Now we are open for your questions.
I will ask the first question then. My main thing here is just, what is the market missing that you're seeing?
Sorry, Andrew, we can't hear you. The line isn't too clear.
Can you hear me now?
Yes, much better.
Okay, what is the market missing that you're seeing in this, opportunity to get this upside? You say is the one thing that the market doesn't see that you see.
I will take that question. We think that the market doesn't see the vitality of the nature these days with the pandemic coming into place. So we see that there's a survey done by the Groundwork Trust ORG, and they have said that 99% of the respondents have said that they prefer green space other than going out, like changing their lifestyles. So we think that market has not seen it yet, but OC has already captured this opportunity with the green space, and they have their own recreational area. So we think that OC is like step ahead of its peers with already captured opportunity. With the budget proposals allowing the expatriates to buy condominiums in Sri Lanka, obviously they would think about the nature. And we think that OCR, facilitated by the Miraka Tower, its value is increasing with a commercial space coming into the play in a like completing their city within the city concept. We think that OC has captured that.
Okay, good answer. I think the next question is like, when will the market or other people see it? For instance, they may see poor occupancies right now, but eventually, like, are we talking about the next month? Or are we talking about in 6 months that the market's going to wake up to this?
This is regarding the like in Colombo, the land is like really restricted, and it's high. It's a high cost to buy a land in Sri Lanka in Colombo, basically. So even though the market captures it buying us, like having a 7-acre garden area is something that the other peers would not capture on, because Havelock City owns the land now, so they don't have to buy it. And the other peers, if you compare Alta, the Shangri-La residencies, so they don't have the land area now, so they have to buy it. But to buy it, the land should be available. So OC has captured it.
So what you're saying is they're a first mover. People doubt their move, but they're going to be proven wrong. Okay, thank you.
Next question from me. Sounds like you're most excited about the apartment projects and less excited about the rental side of the business. Can you comment a little bit on the rental side in terms of the impact that COVID may have long term on especially office rentals, and how that may affect your overall valuation? And is that something that you've taken into account in this whole exercise?
I would like to get this question. Actually, during this COVID-19 situation, the people, they are work from home. They are moved to the remote environment. So actually, in the property leasing side, WTC, obviously they also have to change with the current situation. But like, we don't see it at that much affect this COVID-19 situation to the OC because they like because OC like yeah, that company that they are currently that when it comes to the OC, the tenants which are in the WTC, they have bear a very huge cost when they are moving to another place. So that's we think that we said that we expect that when due to this COVID-19 situation, it may go on in medium term. So the cost that company has, the tenants has to bear to move one place to another place is very high. So therefore, it is more benefit to them to stay in the OC WTC rather moving for another places.
In addition to that, we see the market the port city implementation. So WTC would get an added value from the port city because it is going to become the financial hub in Sri Lanka in the longer term. So before that, we see the other tenants who are ready to capture the market in Sri Lanka. They are willing to move to Sri Lanka. So the best possible interest that they could get to start there, like before the implementation of port city, to capture the market in Sri Lanka, the best place to be is the WTC. And the Miraka Tower has this port technology. It's the first, it is to be implemented in 2022 according to our assumptions because of this COVID situation. So it has this port technology. It's an elevator management system. And Sri Lanka, it has, we can see that in bigger commercial spaces, there's a big time like in, transporting from one floor to another because of the mismanagement in elevators. So we think that like Miraka Tower with this port technology and being a LEED certified commercial building, we expect that will grasp that opportunity.
Adding on to that, the OC has the greater brand equity than the other greater office spaces. So the foreigners out of the Sri Lanka buyers are also attracted to the WTC as well as Miraka Tower. So the brand equity is the main unique competitive advantage for OZ to capture the market.
Adding on to that as well, when like there's according to Morrison and Forrester article, the people after the COVID will put much more effort into the ESG side, where that they will pay much more effort in terms of the health and regulation, which in fact the WTC is in the better place in terms of the health and COVID precautionary setup as well. And also since they have the green building concept already, which was not captured by the other companies in the 90s. So because of that, even they have the higher tendency to attract the tenants with the lucrative advantages. So yeah, this is why we believe that the rental will be much good for the OCs.
I have a question on the valuation you guys are using. Any particular reason why you guys are using different discount rates for the two businesses that you have used? I mean, what's your logic? What's your thinking?
I'll get that question, sir. So when it comes to our valuation, we have separately identified the leasing and services segments and the trading segment. So we believe OC has a unique position, and the two environments that these markets perform are entirely different. So how they perform are different from one another. So that is why we used weighted average cost of equities, the weighted average cost of capital to value the company. So because their performance are different, and we cannot find a particular another company who excels in both of these segments. So we decided to use two to weight these.
Okay.
So question on your discount rates themselves, your WACC about 19%, a little more than 19%, if I'm not mistaken. Your cost of equity was higher than 20.
Yes, sir.
When we are seeing record low interest rates right now in Sri Lanka,
Yes,
can you explain the rationale for using such a high discount rate, especially your equity of 13%? Yeah.
Yeah, so OC in the management clarifications, it was mentioned that OC is not a beneficiary of the 4% working capital rules. So, and the Sri Lankan economy was downgraded by the Fitch ratings, and to perform in a country like, invest in a country like Sri Lanka, the investors need some kind of a reward for investing. So that's why we guess that the weighted average cost of capital is high.
And I guess that the other question is, are you being too conservative in that discount rate?
When we compare to the other, like our beta was obtained with a pure play method by applying the law of large numbers to the peer segment. So with comparison to the beta, like we got the industry beta and unlevered beta, and then regeared it using our debt to equity capital structure. So we guess that it's not too conservative, but it's a prudent attempt in this COVID situation.
I guess I'll follow that up by just saying, maybe you're wrong. The upside is much higher. Why didn't you have a higher upside?
In our scenario analysis, in our best case assumptions, we got a 30.2% upside for OC. When we did the valuation in December, we estimated that the vaccines would come and the economy will recover prior to what the CBSL is claiming, that is prior to the third quarter of 2021. So we believe that with our best case scenario, now the vaccines are coming and the Sri Lankan economy is a little bit gearing up. And the recent the equity reports that the OCs published, we can see half of the returns, like the revenue, is coming from the apartment segment. Like that is more than what we anticipated. From the 2 billion revenue from the apartments, 1 billion has been captured in the fourth quarter, the last quarter. So that means there is an upward trend in the trading segment as well. So that is our answer for that.
Our Q&A time is up. So can I invite Aruna to take on the proceedings?
Thanks, Lanka. I think I have just sent you again the link for our grading meeting. So Andrew, Kanishka, and Deshan, if you can log into that meeting. The sheet also, the link to the score sheet is also there. We can do the calibration and come back to this. Thank you.
Thank you all for being here with us today.
The first team that is to present today.
We're the Team University of Colombo, here to present you our investment thesis on Ceylon Cold Stores PLC.
That projection one.
Good evening, everyone. We are here to present our analysis for Ceylon Cold Stores PLC.
Were you able to find that out?
Their main strategy is using more of the...
Thank you.
Good evening, ladies and gentlemen. Whether it is to quench your thirst,
Sri Lanka's per capita income on the rise.
What about the cost per square foot and this foreign exchange risk mitigation?
Good evening, everyone. We are Team G. First reason why we issue a sale recommendation
Have they taken any? How fast should they expand?
Operational cost acceleration with sugar taxation is impossible.
The runner-up, University of Colombo. Winning the title today, University of Sri Jayewardenepura.
Everyone has one decision that could change their lives forever. A decision to take a different path into exploring new territories and learning new ways of doing the extraordinary. As we take a hyper leap into the future by digitalizing the CSE, you are invited to explore limitless potential with the stock market with the touch of a button. You are invited to enjoy the freedom from the barriers to getting started in the CSE anytime and anywhere. To access research and data in real time the moment you thought about it. Interactive educational content whenever you want to learn. To get in the know with real-time corporate news and video updates. All through one login. Swipe to join the top 1%.
Hi, everyone. Please bear with us a few more minutes. I think we should be back with the winners shortly.
After a lot of calibration, I think judges came up with runner-up and the winner. It is a very close competition. I would say a thin margin, raise a thin margin between the runner-up and the winner. So the runner-up is University of Sri Jayewardenepura Team B. And the winner is University of Sri Jayewardenepura Team A. Again, I would like to say it's a race thin margin, the difference. If the winning team is after we conclude the meeting, if the winning team is still in the meeting, we would like to have the judges would like to have a few minutes chat with you. So just to share a few comments. So if you are still there, please remain after the meeting. Our main event ends. So I think this is our first virtual research challenge we had. I think a lot of people worked hard to make sure that the technical glitches and other organizational issues are minimum. I would like to first of all thank the teams because we had a very limited time to get ready. We had about 2 to 2.5 months to get ready, and notwithstanding the COVID-19 issue, travel restrictions, meeting restrictions, 8 teams took part and all 8 teams presented their reports. And we would like to thank the team members, all teams that participated and presented their reports, submitted their reports, the university mentors, their industry mentors, and the subject company, Overseas Reality. We only gave Overseas Reality a 7 days notice because we did it in a very tight schedule, and they were kind enough to do the presentation for you and also do a follow-up Q&A sessions clarifying the questions you had. I would also like to thank the event-specific sponsors, the research challenge specific sponsors, Colombo Stock Exchange and Kaplan, and our general sponsor, Equity Group of Companies. As usual, as it happened over the last so many years, Equity Knowledge Partners came up as our trading partner. Big thank you to you as well. Then the judges, and as Dinesh mentioned, for the first time we had an international judge, Andrew. All 3 judges accepting our invitation and joining the session. And then the graders, I think led by Rashmi, they graded all the reports within 2.5 weeks, which is a tough ask with their very busy time schedule. So big thank you to all the graders. And finally, the CFA Institute, Travis, Divanka, Srinath, Sandunika, Vanita worked very hard to make this successful. Finally, I would like to thank Samalka, the co-chair, who actually handled most of the event and made sure that everything worked according to the plan. And I would like to thank all of you as well who watched us through Facebook and YouTube channels. Thank you very much for watching our competition and being a strength to our participants. And I would like to conclude the event today, our first virtual research challenge. And as I request earlier, the winning team, that is the University of Sri Jayewardenepura Team A, if the participants are there, please remain in the meeting so that judges can share a few comments with you. All others, you may leave. Thank you.